Welcome back, traders. Coming to you live again. It's been a couple of weeks. My name is Vadim, and this is Rob Mitchell, of course. And I hope that you guys are watching all of the interviews in the series and enjoying them. And today I want to welcome Rob back to the interview. And hello, Rob.
Hey guys, thanks
Hey,
for coming in. Thanks for having me today, Vadim.
yes. Let's start off. Do you have any announcements for us? Major stuff.
Let me see. We've launched the stock index trading room, and that's going strong. We have a real strong subscriber base started in there. It's been live for a couple of days now, and the beta program for that is at no charge, no cost to you until April 1st.
Hmm.
And so I urge you to get in there. If you're watching this and it's before April 1st, I urge you to get in there and get involved with it. I'm also going to be doing some special things for the rooms. I'm going to be doing some special after hours presentations, working from your inspiration, your creativity, and passion for success in all you do, and helping people to tune into that creative impulse that comes from within, that if we follow that, life lights up. And so I'll be doing that. We also have the ES trading program that we're doing with World Cup Advisor that we just started on that. We've been doing that now for, we're in the second week, and this is a holiday week, but things should light up for that starting next week. Should start to see some range expansions. Bond program's doing well, Axiom bond program, and I think those are the main things. Main things that are happening, particularly in the trading area. And
Hmm.
so, unless was there something else that you were thinking that I didn't cover?
So the website for the stock index trading.
Oh, actually, you can get there estradingroom.com or just stockindextradingroom.com.
Okay, gotcha.
But ES Trading Room should get you there too. Let me double check that and make sure I'm not estradingroom.com. Yeah, yeah, that'll take you right there.
Great. And anybody can
Watch
sign up
the
right now for a free demo.
Yeah, watch the video, get the coupon code, you sign up. It doesn't charge your card, but we want to know who you are. It's a
Right.
beta program, so we're asking for your help to make it all it can be. So get involved there and share, and you learn, and we make it better. And that's being run by Scott Bruzzi. He's experienced trader. He's run trading schools in the past, and he's worked with me for about a year now,
Hmm.
and really good opportunity. So hop on that, guys. Hop on it.
Awesome. Let's get to some of the burning questions I have for you here. Let's talk something I've been wanting to talk about for a while, and that is the idea of support and resistance. Basically, does it really exist? Is it there? Why is it there? Does it work?
Support and resistance. Let's kind of cover within an intraday frame first what that might mean. Um, at some level, any of these things are a figment of one's imagination.
Hmm.
And so I'm going to state this in several different ways. Number one, you've got things like market profile levels. Let me see if I can. You got market profile levels, for example, value area high, value area low. Um, there's a huge following for market profile, and so those areas become key. Now, there's three different scenarios without taking into consideration anything else. Where you're opening for the day, for example, you're either opening in the value area
Hmm.
or you are opening out of it. Here, let me open up a ES value chart that I use. That's probably not it. Um, Okay. Here is a value profile chart, or a volume profile chart, depending on what you want to call it. All right. In the ES. Okay. These areas, the value area high and the value area low, are both green, and then the point of control is in the middle. The point of control is where the profile is the thickest, and all of these areas will get action. And so you can see, the market came up, it tagged yesterday's value area low because it opened down this morning.
Mm-hmm.
It came up and it touched that, and the profile players will say, I'm selling that. See? And so that's what it did today. Profile players sold that, and the market's still going down from there. All right. Now, you will see this all the time in just about any market. Another one is the prior day's high. So let me mark this one for you. That's the high from the 21st that I just marked on that magenta line.
Mm-hmm.
So it came up above value. The market actually opened on this day probably a little below value here, and it came up and it took out the prior day's high, and it started languishing a bit.
Mm-hmm.
It couldn't make any progress higher, and so eventually, finally, it sold off from there. And so value area lows and highs, prior day highs and lows, overnight highs and lows, prior pivots,
Mm-hmm.
also floor pivot levels can be, but I don't really get that hung up on those anymore. Also things like Camarilla levels, it breaks the market into zones. Some of the most famous trading systems ever made back in the day were called zone systems. You'd basically say, you'd create a zone system. You'd say, okay, take open plus low plus high plus close divided by 4, and you'd call that price some kind of value, because it's the open, it's the close, it's the high and the low, all averaged together into this one price, and you'd call that some semblance of central tendency or value.
Mm-hmm.
And then you'd take certain percentages above it. Let's say, I'm just going to make this up. Let's say you take 25% of the range and you break it into quartiles going up and down from that level.
Mm-hmm.
Okay? And then you start looking for the market to turn at or around those levels. Now, the very best levels are the ones that other traders are following, and that they're following en masse, because you want them to be on your side, either because their stops are going to get hit, or can you hear that noise?
No. Mm-mm.
Okay. Because their stops are going to get hit and carry your trade to success, or that you're in a range-bound market and those traders are going to come in and fade it, and you want them to be on your side protecting your position. So, another one is the midpoint. So you simply take the session high minus the session low and divide by 2. That's a very good number also, where you get a lot of action of price moving away from that area.
Mm-hmm.
Those are your main ones. Does it exist? Certainly it does. It's verifiable. I can tell you, for example, we're looking at a profile chart. For example, if we open below value on the profile chart, I might ask the question, what's the probability that I'll close below value if I open below value?
Mm-hmm.
I might ask the question, what's the probability if I open below value, what's the probability I'll close below value in 3 hours? Questions like this. And then what we do is we run stats on that. Okay. Well, what I can tell you is, and this is a beautiful thing, this is an edge, big time, is that if you open below value, you're going to close below value in 3 hours, about 78% probability. Okay. So if you open below value and you come back up into range and then you start headed back down, it's 78% to your favor to go with that. Now, I'm presuming you did the stats and that you're not listening to this video a year later and you go, yeah, Rob said that a year ago. No, you're updating your stats all the time. That's what we do, like in our rooms and stuff. We're updating our stats all the time. But that's an example. So does support and resistance exist? You bet it does. Because on some of these stats, overnight high, overnight low, 96%. 96% it's going to hit it. Is that an edge? It's gargantuan edge. I mean, you can bank it. So if you're not trading these things, you really want to start thinking about what that means. And you might want to get somebody who can kind of teach you what that means and how to exploit it. But, like what we do in our rooms, for example. But do they exist with a 96% hit rate? You bet. You bet they do. Yeah.
So, and then things like double tops, double bottoms.
Yeah. Previous pivots, value area high, value area low, half back or midpoint. Fib levels can be, but not so much. I'd rather that you use some of these other things. We got good data on them. I'm not saying the fibs won't work too. That 50% is not technically a fib, but it's a really good number. You have to be careful with Fibonacci. I'll just make a little side thing here about Fibonacci. You have to be really careful about scaling on Fibonacci. Because like if you're in the intraday time frames where the difference between a 618 and a 50% is like 4 ticks or something, then what happens is you just got like, a whole lot of lines on your chart.
Yeah.
And a man with 2 watches doesn't know what time it is. So, same thing with a fib. You got 573 lines on your chart and you go, yeah, see, it came up and it hit this line. Well, yeah, you had a 99.99% probability that it was going to go hit one of those lines. So, hey, you get to be right every day, but it's no edge. So right. you gotta find the things that give you the edge. So anyways, support and resistance, you bet.
So
and that's often associated in 2 ways. Let me just say one more thing. It's associated with targeting or associated with counter trending. So targeting a trend and counter trending, moving away from it.
So what about like supply and demand zones?
Same thing. But see, supply and demand is based on a pivot. So and it can also be based on excess too. So
it's a type of level that gets hit from both top and bottom throughout time.
Yeah, and so like for example, if I am looking at this chart right here, and a lot of people probably aren't used to looking at a chart like this. So let me take the profile off and just leave this chart. If I'm drawing a pivot on this, see, a pivot's nothing more than, or a zone rather, what people call supply and demand zones. It's nothing more than that excess on that tail right there. So the next day it comes down into there, it violates it by a little bit, it finds support there or excess there and comes back up. And what does it do? It comes up into this high. You get excess. From a market profile parlance, you call that excess because it's above that high right there. And you bring that across and you'll find some, it comes up and it tests through that area and then it comes back down. And then you get excess all over the place. This one, I'd probably draw it up a little higher. I'll come up and expect to hit into this area sometime. You had excess here. You opened gap down. It came up and it tagged into the zone and then was rejected there. We saw that also happened to be, not only was it excess in this tail or a supply and demand zone, but it was the value area low. And so now you got two reasons why that's a potential sell area. You also are probably you're testing the first 30-minute high right there, and you may be testing an overnight high in there, or something like that. And so you could possibly have 3, 4, 5 things. Now, some people call that confluence. You have a whole bunch of times it was previously hit in that area, according to a different measure. And so the way I look at that, because really the way I trade, or the way I think of trading, is as a psychologist. And so, or as maybe more appropriately, as a sociologist. I'm asking myself, what are traders doing there? What's this group of traders that trades market profile? What are they thinking right here? Or if we go to this area, what's a market profile guy thinking? What's a supply and demand zone guy thinking? What's a counter trender who fades overnight highs or overnight lows, which is a fairly good strategy, by the way. Can be. What's that guy thinking? What's the guy? Talk about. There's another kind of support and resistance. Some markets like to go a certain number of ticks in a day. Okay. So like crude oil, for example, you go 100 ticks in crude oil. If you go down 100 ticks in crude oil and you don't get some kind of buying there, that's really uncommon. Because that 100 number, the traders know, hey, you win 100. That's $1,
Right.
So that means something to people.
Yeah.
I like to know that means something to. Okay, what does that mean to a market profile guy? What does that mean to a guy who's looking at dollars? Some people trade the net. Is it above yesterday's close or is it below it? If it's above yesterday's close, I'm long. If it's below yesterday's close, I'm short. Some people think like that. Okay, what's the net? Are we above or below yesterday's close? Are we on the open and we're below yesterday's close or above it? In other words, is there a gap on the chart? What constitutes a closing of the gap? Is it to the prior day's high, which is technically the gap, or is it to the close? This, for example, right here on the open was a gap. Well, no, it wasn't, because it was in the prior day's range, and so this we call a lapse. That was Larry Williams came up with that term. Some book I read 25 years ago. It's a chapter called "Oops" or something like that, and this idea of differentiating between what looks like a gap. Let's see if we can find a legitimate gap on the chart here. Usually they'll fill in and you won't see them. But this is a lapse. When the market comes down and it leaves a little bit there. It didn't cover to the close, that day's close, which is right there. And so it leaves a little bit of a lapse on the chart. And then later when it comes and tags into that lapse, not only is it a supply and demand area, but you expect to find some buyers there. So there's all different ways that different traders will consider support and resistance. Now, here's the problem. There's too many of them to know, and so you got to pick. You got to pick your ones. What are the biggies? Previous day's high, low. Previous day's close, midpoint or half back. And the market profile levels. Those are the main ones. And so you look at those, and you kind of weigh out what's happening within that framework. Yeah.
Want to transition to larger time frames and talking about the big money, the banks, the institutions. moving the market and watching the big time frame, how should smaller traders apply this?
Well, a lot of the trading that I do in crude oil, for example, is in these intraday frames and patterns. And so I talk a lot with the traders that I train about, it's a market profile term called OTF, other time frame participants, or higher time frame traders, you know. So there are different times where those parties are likely to be present in an intraday frame. So I think of it like a party. Okay, you're at a party, and there's so many people there, and they're interacting amongst themselves, and they're creating an environment amongst themselves. All right, and then Bill Gates walks in the room.
Mm-hmm.
Okay, and Bill's got more money than everybody in the room combined.
Mm-hmm.
Okay, so if there's some kind of trading going on, Bill can cause a huge imbalance in what's happening in the kind of mindset of the room. The room kind of generates this energy in the way things are going, and then Bill walks in. And everybody knows what he looks like. Everybody knows who he is. So everybody suddenly goes, oh, whoa. And now they're not paying attention to the patterns that they were on their charts. Now in trading, you can't really see that guy. That guy doesn't care. You got patterns you're trading on your chart. You're all excited, interested in the overnight low or high or whatever. And this guy steps in, and he owns 400 giant tanks of crude oil sitting on a hillside someplace, and they're all full. What's this guy care about a penny? This guy's not playing with beans like, it's not $100. This guy's dealing with millions and millions and millions of dollars, and he steps in. Well, where is it likely that he's playing in that market is either around the open or the close of the day, or around the report, around the time a report's coming in. And so the population of who's in the room can shift around the time of just before a report, just after a report, at or around the open, at or around the close of the day. And so I'm always aware, or trying to be aware, where that shift in player might be happening, because I don't want to, typically you'll see price action do things that aren't in line with a pattern. In other words, you get things, I call it an encompassing pattern. It's where the normal cycling gets broken. That's usually some kind of an event on a chart when that happens. If that's happening at or around a report time, I don't want to trade into that, because the things that I make my trading decisions based on are not being followed, and so I expect that there's higher time frame players there, and the price action is showing me that there's higher time frame players there. I let them get their business done, and then I'll step back in as it starts cycling and following the patterns again. So, but you can think of it like a poker game or a party or whatever. When somebody else steps in the room, the dynamics of the party can change. It's an easy metaphor for just making sense of that. Trading, like I said, trading's interesting in that way because you can't see. It's not like in the old days you could, you see who's on the floor. You might know, a certain floor broker handles such and such as orders. Oh yeah, man, that's the guy that isn't that the guy that handles Monroe Trout's orders or whatever, You're like, yeah, man, he's coming down here. Oh, whoa, better see what he's doing. I'm not placing an order ahead of him. That guy could eat me for lunch.
Better trade with
So
him.
Yeah. So with this, these days you can't see that. So you gotta be thinking.
Mm-hmm.
You gotta be thinking who's in the house.
Yeah, yeah.
You know what I'm saying? So,
Mm-hmm.
yeah, that's part of the fun.
Let's talk about trend day psychology.
Okay.
Like on the ES or index futures, you only have about 2, 3 really trending days per month,
Hmm.
and a lot of traders can lose a lot of money on those days.
Yeah, it's we've all done it, right?
Yeah.
Basically, fade the day, right?
Mhm.
And it just keeps going. The fade the day
Mhm.
just keeps going. Fade the day it just keeps going. Now in crude oil has been slowing down for a long time, and we call it a beach ball.
Mhm.
Well, what happens if you hold a ball underwater? I mean, you really get it down underwater, and you hold it, push it down further and further and further, right?
Mhm.
And then you let it go. I mean, if you're a kid, it's a lot of fun, right? Because the ball comes
Mhm.
flying up out of the water, right?
Mhm.
And then you're like, wow, that was fun, man. Let's do it again, right? And so, well, in when I use that metaphor to describe a market movement, um, it's uh, it's short covering.
Mhm.
Okay, it's short covering. So the market has been down, down, down. You got a lot of people who are long term short, and what happens is they get. What happens if you What happens if you sold at a market, whatever it happens to be? Let's say you sold the market at 100, and it has trended all the way down to 67.
Mhm.
You're sitting pretty comfortable.
Mhm.
You know, you're like, "Phew, I don't even look at it anymore.
Mhm.
It's like this giant position on, and it's moved way away from my entry. I'm pretty comfortable, right? Well, what happens is that beach ball starts edging up, edging up, edging up.
Mhm.
All those guys that are comfortable, it starts putting pressure on them, you know,
Mhm.
to protect.
Mhm.
And then their orders, their buy orders to get out of their shorts, just market just goes fast.
Mhm.
Okay. Well, that can happen very abruptly, or it can happen in a more orderly fashion, and the market can just go vertical.
Mhm.
Now I'm using an example of the market going up in this case, but
Mhm.
go the other way too. Um, what's happening is um, it's forcing the longer term players to deal with the situation. Now, the market's either going to do that in a cycling fashion, okay, or it's just going to go vertical. Let me see if I can find a chart that would. Um, okay, I'm doing. This is the June contract, so as we get back in here, it's going to start looking a little funky. But basically, this is not unlike the pattern that we see. You're going vertical here, actually up into here. Um, and then you'll get these little retracements, and you
Mhm.
get perfect cycling. Okay, perfect cycling. This is the exact kind of pattern that I uh, like to teach people to trade. There is no violation really of a prior low. Maybe you could make the argument there's one right there. We call that a trap. It takes out a prior swing low. By the way, this is the support and resistance topic again, right?
Mhm.
You took out a prior swing low or zone, um, and then you reversed.
Mhm.
Did it here too. You had this little swing right here, and it took it out. Now I call that a trap. What happens is you get a bunch of traders in here decide to go short, and then this market movement upward is from their stops. So the market goes through a natural cycling. of old money to new money and then back again. So what do I mean when I say that? Well, somebody who's already in the market, that guy who sold at 100 in our hypothetical situation a couple minutes ago and rode it all the way down to 67, and he's sitting pretty sweet. That guy's old money, right? He's if he makes a trade, he's exiting the market. Right? Now, all moves are initialized by that kind of activity. But you got all different time frames going on. You got the guys down in the little intraday stuff. You got the guys on the swing trade. You got the guys on the daily charts. You got guys on monthlies. You got guys who are commercials who don't really care that much, but are coming in. There's all these different groups. Again, just looking at it from the viewpoint of a sociologist or whatever, right? So, you'll get this kind of short covering coming off the bottom, and then you'll get some profit taking. These are long guys who are liquidating their position right here. And then somewhere as they liquidate their positions, new money steps in and goes, I'm going to short this. Right? And then they get trapped. And then it starts coming back up again. Their stops, those short guys' stops, fuel this higher as they're wrong. Now they just got in, they're new money, right? And so they're going to shake out a lot easier than somebody else who's been in for a while longer. Okay. Now you already got a bunch of longs who are still long, who's saying, I'm not getting out. I'm up nice, man. I got in this at 1800 and now it's at 1940. $5,000 a contract or whatever, right? And so as it goes higher here, new money steps in and takes this higher. New money. All right. Going with these guys who initially got in. The real smart guys got in down here. Now, if you want to learn about this topic in a really interesting format, read Malcolm Gladwell's the one about how trends get started, The Tipping Point. Read Malcolm Gladwell's Tipping Point. I think he breaks it down into 5 groups. You got early adapters or something like that. You got people who are innovators who start something, and then he talks about how that becomes a trend or even like a social movement. The exact same thing that Gladwell's talking about there. He's a brilliant writer and author. Brilliant. You should read all of his books. I don't care who you are, especially if you're a trader, because all of Malcolm Gladwell's books that I've read are trading books as far as I'm concerned. But anyways, read The Tipping Point because it's about this exact thing. It's about how these 5 different, I think it's 5. It's been years since I've read that, but how these 5 different groups are fueling towards something that goes like this, and so and what they're thinking. He puts them into different categories about how and what they're thinking. But so this is a fairly orderly ascent, just A, B, C, D, E, F, G, H, I, J. You just they give them letters. You can count them. Say 1, 2, 3, 4, whatever. And so this is an orderly trend. So how do you know that the market's trending? Which is really what your question was. Well, read Malcolm Gladwell's book, and we'll move on to another topic. We'll cut it there. But how do you know you're trending? Because this is what you're going to get in a trend. It's just going to go like that, And because they're not going to be willing to sell it all the way back down to the trap. And if they do trap it, say thank you very much. Let me hear everybody say thank you. Thank you for that great opportunity to re-enter. And so that's how you discern a vertical day. Now, what else will a vertical day be doing? Well, it'll be going into new territory.
Mm-hmm.
you know, and it'll probably be doing it with gusto, you know. So if like you're looking at the order book, it's going to be jumpy and it's going to be skewing towards the people are going to be placing limit orders to get out, get out, get out. Now we've talked about this in prior interviews. As a market goes higher, like on what we're seeing right here on this chart,
Mm-hmm.
the number of participants in the rally decline
Mm-hmm.
because you trend on low volume.
Yeah, everybody's
So
already in, right?
yeah, I bet if I let me put a volume on here. Let's just, you know, uh, reading volume on daily charts is a oh, there we go. You learn something new, learn something new every day. I don't use this particular charting package for my longer term analysis.
Mm.
So
But
first
yeah,
time.
you're right. The volume is declining there on the rally.
Yeah. Um, the generalized theme. Now here, as you get towards the bottom, you're getting to a lot of fear.
Mm-hmm.
Because in stocks, this is a funny. I'll tell you guys something funny. In the stocks, 98% of the players are long,
Mm.
and so the volume will pick up as you go down, because these guys are terrified.
Mm-hmm.
They're terrified as it goes down because they're long,
Mm-hmm.
you know. And these guys are hedging. These are institutions hedging. They're going short to protect their mutual fund positions or whatever. You're with
Mm-hmm.
me. So you know, reading volume can be a very complicated thing. And so don't just take the kinds of things that I'm telling you and analyze them out of context, because it could get you into trouble. But this is the general tendency. Um, this is the general tendency to um, decline as the market starts going higher. There are fewer and fewer participants because they'll all decide, well, it just can't go any higher. This is
Mm-hmm.
just natural for a human to think this way. It
Mm-hmm.
just can't go any higher. Well, what do you mean it can't go any higher?
Mm-hmm.
Well, it just, it can't, it just can't. Really? Well, that's about the time it will. So
Mm-hmm.
when you're in a vertical move, when your brain is saying, oh, I can't go any higher, you know. Now, a few minutes ago, I told you, you go 100 ticks in crude oil,
Mm-hmm.
they're going to fade it. That doesn't mean it won't continue, though. I promise it doesn't mean it won't continue.
Mm-hmm.
But uh, there's a good chance it's over because, as you said, you only go vertical a few times a month, if that even. And so most of the time, and this is another reason why traders get trapped in this stuff, is because most of the time they're able to get away with fading extremes. But then when
Mm-hmm.
it hands it to them in a really big way. Counter trend trading, this whole world mentally of counter trend trading, this is a dangerous place for a lot of traders, because if you are counter trend trading, you can get caught in the days that go vertical.
Mm-hmm.
With it going against you, you just keep
Mm-hmm.
fading it. Fade, stop out, fade, stop out, fade, stop out, fade, stop out. This is not dissimilar from selling option premium, where you make 10% a month,
Mm-hmm.
and you make 10% a month every month for 6-8 months, and you're going, yeah, man, I'm up 60% after expenses. This is great, man. It's like taking candy from a baby. It's like shooting fish in a barrel. And then, bam, it nails you.
Mm-hmm.
Yeah. And so that's why I teach trend trading first, and then counter trending as a form of trend trading. And so there's a couple of different ways you can do that. This is an example of a counter trend trade. If you're fading this, you're fading the trap. You're fading the
Mm-hmm.
trap. See, you're counter trend trading in the trend in a larger context trend.
Oh, okay, right. Mm-hmm.
But then also to be able to fade these, I mean, okay, you're taking out this major pivot. We just talked about that a few minutes ago. It's a major
Mm-hmm.
pivot. I expect to find sellers there. Yeah, you bet, man. Look,
Somebody bought
sold it
there.
down for a couple of days. Yeah, somebody bought there, right? And then they get trapped,
Mm-hmm.
right? That's a trap. Same thing here. Came up into this little supply and demand zone right there, and that little excess in that tail, and it faded right there, like to the tick,
Mm-hmm.
right? Okay, so these can be great fading things. For me, I'll be sitting there looking at that, looking at the daily chart, and you know, I know that this is a big scale. I mean, from here to here is 1805 to 1938 is 140 handles, right?
Mm-hmm.
140 handles. So I'll just wait to get a little one of these going on and then come back up and tag back into it and sell it.
Mm-hmm.
So instead of just blindly fading that,
Mm-hmm.
I'll wait for this. Now I know when that fires that's a trap. That's exactly what I described to you as a trap here. But I waited for the retracement after the trap. Okay.
Mm-hmm.
And I'm very well aware it's a trap when I'm doing it, so I'm ready to reverse. So I've got both sides of possibilities in my brain when I'm firing it.
Mm-hmm.
Huge difference between somebody who's counter trend, and they're not looking at both sides of the equation
Mm-hmm.
as they're taking it all in. And this is what comes with time. Understanding these contexts. Well, what's the support and resistance? Where is it? What's the market profile traders thinking? What's this happening? Are there other time frame participants in the market? And then you start just summing these things together, and you start looking at a chart and saying, "Hey, wait a minute. There's nobody to defend this thing going out into open territory here. As it goes up into here, nobody's going to stop it. There's nobody to stop it once it goes out here." And so you go, I got to go long. I got to go long. I'm crazy if I don't.
Mm-hmm.
And then you manage the position. You manage it. And so all those things start coming together in that way. And I know that sounds kind of complicated, but it's something that you come to over time with practice. Trading's like a profession. You get a medical degree, you go do an internship, you open a practice,
Mm-hmm.
and you learn as you go. Trading is like that way. Anybody who thinks that you can that it's fixed. Trading's a process. You're constantly honing your skills, getting better,
Mm-hmm.
and learning more and more. And so you know. But that's why I run the room too, because what happens like in our trading rooms is people give me feedback. Oh yeah, this is happening. They're like, whoa, I'd never thought about that one.
Mm.
And then you're the teacher, but you're learning from the student because or maybe they'll ask you a question that just completely blows everything you thought out of the box.
Mm-hmm.
And you're like, what did you just ask me? What? And they're like,
Mm-hmm.
yeah, this, and you're like, whoa, suddenly all the charts look different. It's like they completely remapping in your brain as you're
Mm-hmm.
like, oh, wow, man, I never saw that before. I've
Mm-hmm.
been looking at this chart for 20 years, and suddenly it's all different, you know.
Uh-huh.
Now, the funny thing about a human is uh, your brain rewires when that happens. And
Mm-hmm.
so you don't remember what you didn't know before because
Mm-hmm.
you actually rewire.
Mm-hmm.
You start thinking of the implications of these in a court of law as a witness or something. People's
Mm-hmm.
brains rewiring all the time.
Mm-hmm.
It's crazy. So, you, you actually don't need to know all these things that we talk about in the interview to be successful as a trader. But if you keep at it long enough, you're just going to, more and more things reveal themselves to you, and you just talk about it fluidly like we do in the interview here. But you don't have to know these things. Just start with the
Yeah.
basics, and you can do well.
Yeah, it's almost impossible to imagine um, the time before you knew something.
Right. Do you ever get in I love to ask people this. Do you ever get in an argument with someone about something? They said, "Oh yeah, you said such and such,"
Hmm.
but somehow between the time that you said it and now you'd really revalued, or you had a change in your belief,
Hmm.
and you found that you were defending that you hadn't said it, what you had said, because it was no longer consistent with your present moment belief.
Hmm.
But there was something kind of back in there that was telling you, yeah, that's not exactly right.
Hmm.
But you wanted to defend your present moment belief because they were challenging you about something that you had said or behaved in the past,
Hmm.
which is no longer relevant to you. So it's correct for you to be defending it because you're different now, because we're all different every day.
Hmm.
And so, but yeah, you're rewiring all the time, and your brain can't always keep an accurate measure. It'll remember events, but it may not remember things that happen at a level below your consciousness, like a change in a belief or a change in a value. Values can change
Hmm.
and beliefs can change, but you're not aware of what your beliefs are, unless somebody brings it specifically to your attention. So you're actually acting on beliefs that you have about things, and that's how that counter trend trader gets in trouble. It can't go any higher. It
Hmm.
says, sell it, stop out, sell it, stop out. It can't go any higher this time. I'm gonna
Hmm.
double it up. I can't. I'm gonna triple up. Some
But then
martingale,
after about five stop outs, they just give in and they
and then
buy
it
it.
goes, and then it counter trends,
Yeah,
like
that's the
clockwork,
worst.
like
Yeah.
clockwork. Yeah, and so that's the single hardest thing about learning to trade, is to not get caught with the herd mentality,
Hmm.
and to stay true to your method and your process. Because the minute you're saying it can't, if anybody who's a trader has got the word "can't" coming out of their mouth, has got
Mm.
gonna have a problem.
Or should.
Or should, enough, should, can't, try.
Hmm.
There's no try. I love that quote from Yoda. There is
Hmm.
no there is no try. Just do.
So it seems like if a trader misses like this, let's say we're looking at the intraday chart, 5 minutes that you got on and whatever, and the trader misses this run up, well, he immediately starts looking for a counter trend because he's looking at the past and says, well, I already missed so much that even if it goes up, it's not going to be a lot, so it's got to go down. So he starts looking for a counter trend because he's late to the party,
Right.
even though it has nothing to do with reality.
He's just getting his brain on the wrong side of the equation. And
Hmm.
so it's a mental trap. And I'm going to tell you something. I know a lot of these things get into like psychology and stuff like this. Here's the big thing with this whole thing. Now we're sitting here chuckling about it, and we chuckle about it because we've done it. But here's the difference. Here's the difference. If you resist that you made exactly the wrong decision, if you resist it and you demand that you're right in some way, I absolutely promise you, you will not learn the lesson that the market is trying to teach you, because it's doing you a big favor. Oh yeah, you lost money, but education costs, okay?
Hmm.
So when you do that, if you humbly, you know, I love scriptural references because they just take it down to one thing. Resist not evil. Well, what's the evil? The evil is me resisting that the market was trying to teach me something. So if I just go, oh, hey, the market, I just lost money. Why? Oh, yeah, I get it. I'm acting like an idiot.
Mm-hmm.
I'm not thinking, in line with what the market's really trying to do. Because that's what, when you lose money, that's what it's telling you.
Mm-hmm.
And so if you can just be humble, take your loss and go, what can I learn from this? And if you can't draw anything from that, you might do well to find someone who could answer that question for you. So join the trading room and ask me, go, hey, Rob, this happens.
Mm-hmm.
Okay. Well, yeah, I've been there. I've done that. And this is what you're thinking at the time. And I'll probably say, correct me if I'm wrong. Correct me if I'm wrong. This is what you're thinking. This is what's going on in your head. And this is what the market's doing. And so then you go, oh, I get it. I get it. It's a trap. Yeah, it's a trap. Market traps all day long. And so one trap after the other all day long.
Mm-hmm.
Because markets trend on low volume. And so only the smart guys are in that trend. All the dumb money got out, see? Markets trend on low volume. So there it tells you. So I have a note. I have a note here to discuss in my trading room tomorrow. Something on the subject. It just came to me today. Just something that came to me in the moment, and I said, who is responsible? I wrote it this way. Who's responsible for the patterns that you're seeing on your charts? The smart guys or the dumb guys? Is the pattern that you're seeing on your chart the result of the smart guys, or is it the result of the dumb guys?
Probably of the losing traders.
Yeah. So the patterns that you're seeing on your charts are actually manifestations of incorrect thinking people. Think about that. That's staggering. That's a staggering thought. I haven't even wrapped my brain around it yet, but it just came to me today while I was lecturing. That the pattern on the chart is dumb guys. So what do you got to do? You got to start thinking, well, if it's dumb guys, where are they gonna get stopped out? That's where I want to be. Because then their orders, being old money, relatively new old money, because they're trying to come in and scalp for $100 or something. Relatively new old money. Their stops are going to carry me 5, 6, 7 ticks so that I can get into a trade with relatively low risk. And then every so often it's going to carry away and turn into $1,000 trade. And there you have trading in a nutshell. It's so easy. It's so easy, but it's so hard. But it's so easy, but it's so hard. So, anyways, there's trading 101 for you right there.
So it seems like a good idea to have to trade two sides, to have a plan for a short setup and a long setup.
But you have to see both at the same time. Now, once you start learning the market from a price action standpoint, you'll start realizing that at any given time that you're going long, I might be able to tell you 7 reasons why I'm going long and 3 why I should go short. So that's long. The best systems ever, we've talked about this in these lectures, the best systems ever are designed like this. There's 7 reasons why I should be going long. The players in the market, to my best ability to analyze it, are going to end up pushing this thing higher. And the weak hands aren't going to be able to sustain it, and it's going to push them out of the game, and their stops are going to fuel it my way. And then hopefully new money will step in and carry it into a big trade. How often does that happen? Relatively small percentage of the time. How often do you get caught in a trade more than, say, 20 ticks or something? There's maybe, not even 30% of the time if you're trading intraday, right?
Mm-hmm.
And so you're looking for that runaway.
Mm-hmm.
You're looking for the 40, 50, 60, 70, 80 tick. And then you have to have the intestinal fortitude to stay with the trade and let it develop into that kind of a situation. So you line yourself up for the entry where it's probably going to carry away from you. Hopefully you're looking at the other side of the equation at the same time so that you can understand, well, the tables could turn.
Mm-hmm. Mm-hmm.
Now, on the one where I gave you, it's 7 against 3.
Mm-hmm.
The table's probably not going to turn on that one.
Mm-hmm.
That one's decisively long.
Mm-hmm.
But a lot of times when you're trading, you're looking at both sides and it's like, 60-40. That could easily turn into 60-40 the other way. And so either you're going to say, I'm not trading 60-40. Forget it. I'm sitting on my hands. I call it sitting on your hands. If you go standing desk, it's standing on hands. SOH, either way you look at it. Sitting on hands or standing on hands. I'm just going to sit out. Oh, yeah, but then you're going to miss the big move. Well, guess what? So what? I don't care. Because in the end game, you want to get caught in big trades, and big trades don't often come out of situations where there's balance. You need some disagreement as to the pricing for the market to have a range expansion. And then, if you can get some kind of metrics on the on what's normal, it's like take crude oil for example. Like, every day, 120 ticks. Every day, 120 ticks. So that's normal. What that means? It's really interesting. If you frame that, what it's telling you is that with the participants that are at this party, day after day, assuming that it's something relatively constant, with the participants that are at this party, you have 120 tick move every day where the market is still in agreement as to what the pricing is at the end of it.
Mm-hmm.
So that's another way you're in a vertical day, is you're past 120 and it's still cycling. Then you lay that into, it's 120 and it's still cycling, and it's into an area that doesn't have a bunch of supply and demand zones or prior highs and lows or, previous day's highs and lows. It's just going to go jamming right through it. And that's when you're in a, now this is the other side of the equation. One, it was standing on hands or sitting on hands to not get into a position because there's a good chance it's just chopping around.
Mm-hmm.
And the other one says, no, I'm in a position and I'm standing on my hands because I'm going to get caught in a 100 tick trade today.
Mm-hmm.
Because this thing's going, and I don't care if it comes back 25, 30 ticks against me. I'm holding it.
Mm-hmm.
And so those things, when you're trading at that level, you're understanding the market from several viewpoints. You're understanding it at the entry level on both sides.
Mm-hmm.
At the entry level, you're understanding it on a larger picture. What's the range expansion potential, and is it cycling, and this kind of thing that opens up the opportunity. And then you're saying these things are lining up. I'm probably in a vertical day here. I'm going to take a stab at a big one, at least with a portion of your position.
Mm-hmm.
And then so many times a month, as you said, 2-3 times a month, you get caught in that, and that makes your month. Or it has a big contribution to it.
Mm-hmm.
And so a lot of traders get into trouble psychologically with this because they don't believe, if you grew up in a family where your parents went to work every day and you heard them saying things like, oh, I got to go to work. Oh, yeah. Well, we can't buy that, honey, because, things cost money and we just don't have that kind of money. If you think like that, you may, I probably talked about this in other interviews. You may not believe, because trading's really weird, man. You get into a position and you start racking up money, but you haven't done anything.
Right.
Well, that's a really complex idea for a lot of people. Wait a minute. Wait a minute. You mean if I just hold this thing, I'll make money? Yeah, that's right. Okay, well, guess what? If you have a belief that by the sweat of your brow you shall produce on this earth, if you're a trader, you better clear that, because if you're a trader, you need to think, okay, scientists tell us that the universe is expanding from a big bang in an infinite, expanding sphere in 3 dimensions. And then, if you took, math, you go, hey, don't spheres increase by the cube of their distance from the center? Oh, yeah. Yeah, if it's increasing by its cube, that means the universe is getting better at it's getting more abundant at a cubed rate. Well, am I part of that? And then as a trader, you go, sure, yeah, I'll take it. Then you start saying, oh, yeah, $100 bricks, $100 bills come crashing through the roof of your house. You start thinking like that, right? And so, I'm just being fun here, but I'm saying, as a trader, you're going to be a lot happier if you have an abundance viewpoint, because if you have the abundance viewpoint, you're never going to say it can't, or it shouldn't, or it won't, or it's gone enough, or it's gone as far as it should, or, well, I'll try to let it run, but try isn't do. And so, you know what I'm saying? And so,
right.
The abundant universe viewpoint can be a huge game changer for a trader.
Right. All the money has already been created.
Everything's been created. Everything exists. Yeah, everything exists.
There is no scarcity.
There's no scarcity. Even if it's like, so, okay, all the market's crashing. It's like, oh, Chicken Little, the sky's falling. Well, guess what? Before the market started crashing, there were 1,000 cattle on that hillside. And the market crashed down 5 million points, and, the whole economy is going in the tubes. There's still 1,000 cattle sitting on the hillside. There's still 100 grapefruits on my tree. There's, nothing's changed. Somebody pointed out the other day, and I've always thought this is an interesting subject. It's like, okay, the stock market. Everybody's long player, right? And not that you'd want to like short General Electric or something, because you got some really smart people trying to make that go up, right? So I would never really, at least for any length of time, want to take a bet against the economy of the United States. So you know what I'm saying.
It's like shorting Dow. You don't want to short Dow.
Yeah.
They get rid of bad stocks, so.
Yeah, they roll out to the better stuff, and so the whole thing's biased up, right? And so, I forgot where I was going with that, but
I interrupted.
Yeah.
Well, 1 hour is up anyway, and we're gonna end here, and we're gonna do again next week.
Okay.
And I hope that more people join the beta program on the stockindextradingroom.com. And I know that you're working on something else, but we can leave it for next interview, something to do with helping people in their personal life.
Yeah, and traders too, expanding your consciousness and these sorts of things. I got a tremendous amount that I'm doing in that area. In fact, probably the better part of my resources are going towards that kind of work these days. The work that I do with traders in expanding consciousness and in life. And I do work with all kinds of people. I'm working right now with a guy who's a crack addict, and And to help him, he's finally decided that he wants to get free of that and get himself empowered again. And just a wonderful thing I do. But yeah, there's some things happening there that we'll share on future interviews. So
Great.
Yeah.
Thank you very much, Rob, for all your insights.
Oh, thank you for having me, Vadim. It's awesome that you're putting these on. So
thank you.
Okay, guys, thanks for coming in, and we'll see you next time.
Bye-bye.